Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Phil Mackintosh, chief economist at Nasdaq, to discuss why ratings agency Fitch downgraded its U.S. credit rating. And of course, we'll cover second quarter earnings performance so far. Phil, it's great to see you as always. Welcome back to Trade Talks. And that headline that hit, I guess it was around 5 o'clock yesterday, I don't think many people were expecting it. What was the rationale behind Fitch's move?
Yeah, I mean, in reality, we probably shouldn't be surprised, having just lived through the debt ceiling again. And we saw in 2011 that S&P downgraded us for kind of the exact same thing. So in a way, we kind of did this to ourselves. But what they said in their announcement is they're worried about the governance issue, which we just talked about. They're worried about the fiscal deterioration in America. And when you look at the amount of debt that we're running, we are now pretty close to 100% government debt per year of GDP. And the expectation is that that's going to keep going up, potentially getting to 200% by 2050. And so that's going to create a huge debt burden that we're going to have to all deal with. And if the interest rates stay high, it's going to be a lot of interest expense too. So it kind of does make sense that, fiscally, we're not in as good a position as we were 10, 15 years ago.
How has S&P performed around situations such as this, or, debt ceiling shutdowns?
Yeah, we really only have, I guess, one real example of this, and that's in 2011 when the S&P downgraded us. And it was in the middle of a slightly different time because back then we had the European debt crisis as well. We looked like we were heading into recession then as well. So when the announcement came out, the stock market fell a lot. It fell to 10, 15% and stayed down there for quite a while. Volatility picked up. So it's, I guess, one example of a data point, but it looks like, just looking at the market this morning, that's not as big a deal as we're seeing right now. It's this particular experience is not as big a deal as it was back then. So I think the market is absorbing it relatively well. The problem really is that the interest rates, if the government debt gets downgraded, interest rates that everybody pays might end up being a little bit higher for the rest of our lives. And so that's going to slow our economy down just because we won't invest as much as we would with lower interest rates.
Let's talk about earnings season. Would you say that we're in an earnings recession at this point?
Yeah, I mean, it's kind of interesting. We're not in a recession, but if you're a company, you probably do feel like we're in a recession. So looking at the last few quarters, we've seen declining year-on-year reports of earnings. The quarter that we're in right now is sort of halfway through earnings this week, and the expectation is that earnings will be declining about 7.5%, which is the biggest drop in the last 3 quarters. But we've had 3 quarters of negative or falling earnings reports. So we are kind of in an earnings recession if you look at the broad market.
And how about manufacturing? How are those sectors being impacted?
Yeah, I mean, it's kind of interesting looking at what's going on. The consumer's been really strong. The consumer has actually been kind of spending enough that it's holding the total revenues up, but margins have been getting compressed. And if we look at the different sector performance, you can see not every company is seeing the same results. So the consumers, we know they've pivoted from goods buying into services buying. We know they're now doing a lot of revenge spending in leisure and hospitality. And so you're seeing that in the consumer services, which are actually seeing growth, in industrials, which includes the airlines, which are seeing growth. And then the flip side is that slowdown in manufacturing is pretty dramatic. And you can see it in materials and energy. Those companies with oil prices falling because of demand falling, you're actually seeing their earnings contracting. And so that's really what's pulling the whole market down.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.